Welcome back to the deep dive. If you're gearing up for your ACCA Audit and Assurance exam, well, you've come to the right place. Today is all about the absolute core of the audit, the evidence. We're moving past the planning stages, past the theory, and getting right into the practicalities.
That's exactly right. Our mission today really is to help you master how we actually gather, how we test, and ultimately how we evaluate the audit evidence, the stuff we need to actually form that audit opinion.
Yeah.
We're diving deep into concepts like sufficiency, appropriateness, audit sampling, and critically linking all of that back to specific financial statement assertions.
Because this is where the rubber hits the road, isn't it? Chapters 10, 11, and then that big block from 16 through 23 in the syllabus. It covers everything from the basics of evidence right through to detailed procedures for specific accounts.
Precisely. And it's often where candidates struggle a bit, connecting that initial risk assessment from planning to the actual practical tests you perform. That's the key linkage we want to build today.
Okay, let's do it. We need clear, actionable insights, stuff you can actually use in the exam. Because at the end of the day, the entire audit process planning, risk response, review report, it all hangs on whether we get enough good evidence. Sufficient, appropriate audit evidence.
That's the bedrock, ISA 500. And it's not just a phrase. The quality of that evidence directly impacts the level of assurance we can give. Get weak evidence, you get weak assurance. The audit might even be, well, worthless.
Okay, so let's start right there. ISA 500. Sufficient, appropriate audit evidence. What does that actually mean in practice? Let's unpack it, right? This core requirement. Sufficient, appropriate. They sound similar, but they're distinct concepts, aren't they?
Oh, absolutely distinct. And auditors are constantly balancing them. Let's take sufficiency first. That's all about the quantity of evidence. How much?
Like, how many invoices do I need to look at? How many inventory items do I count?
Exactly. And the answer is, well, it depends. It's driven by the auditor's professional judgment. But crucially, it's directly linked, actually, inversely linked to the assessed risk of material misstatement, or ROE.
Inversely linked. So if the risk is high, I need more evidence.
Precisely. Think about it. If you assess inherent risk is high, maybe it's a complex industry, lots of estimates, and you find the client's internal controls are weak, well, that combined risk, the ROE, is high.
Okay.
So you can't rely much on their systems. You have to gather more evidence yourself. More quantity. You need to test more transactions, larger sample sizes.
And conversely, if ROIN's low, maybe strong controls, stable industry.
Then you need less quantity. You can perhaps rely more on the controls, maybe use smaller sample sizes for your substantive tests. It's about achieving that desired level of assurance efficiently.
Okay, that's quantity sufficiency. What about appropriateness?
Appropriateness is all about the quality of the evidence. Is it good evidence? And this breaks down into two key components, relevance and reliability.
Relevance first. Does it actually connect? Does the test address the specific thing I'm worried about?
Exactly. You have to target the assertion. Let's say you're worried that inventory might be overvalued because it's obsolete. That's the valuation assertion.
Right.
If your audit procedure is just checking if the inventory physically exists in the warehouse, well, that tests the existence assertion. It's completely irrelevant to whether it's valued correctly. The obsolete stuff might still be sitting right there on the shelf.
Ah, okay. So the procedure must match the risk, the assertion. That's relevance.
Spot on. That's a classic exam trap, by the way. Misaligning the procedure and the assertion.
Good tip. And the other part of appropriateness, reliability.
Reliability. This is absolutely critical. How trustworthy is the evidence? Auditors spend a lot of time thinking about this, and there's a kind of hierarchy of reliability. This determines how much weight, how much comfort we can get from a particular piece of evidence. #, B, reliability, hierarchy, exam gold.
Okay, hierarchy of reliability. This sounds important. Exam gold, you mentioned.
Definitely exam gold. Because understanding why some evidence is better than other evidence is fundamental. There are some general rules.
Rule number 1.
Generally, external evidence is better than evidence generated internally by the entity. Think about it. A year-end bank statement or a confirmation received directly from the bank is almost always going to be more reliable than looking at the client's own cash book reconciliation.
Why? Because the bank is independent. They don't care if the client's balance looks good or bad.
Exactly. They have no reason to misstate it, generally. That independence is key. Which leads to Rule 2. Evidence obtained directly by the auditor is better than evidence obtained indirectly or from the client.
So if we go and observe the inventory count, or if we control sending out and receiving back receivables confirmations, That's stronger.
Much stronger. Because the client hasn't had the chance to filter it, to hide anything, or, potentially manipulate the information before giving it to us.
Yeah.
We control the process.
Okay, external, better than internal, direct, better than indirect. But we do use a lot of internal evidence, don't we? Client documents, ledgers.
We absolutely do. And that's where Rule 3 comes in, adding that nuance you mentioned earlier. Evidence generated internally is more reliable when the related internal controls are effective.
So if we've tested the client's controls over, say, purchase recording, the three-way match, approvals, etc., and found they work really well, then the purchase invoices and ledger entries generated by that system become more trustworthy.
Exactly. If the system producing the evidence is robust and reliable, the evidence itself gains reliability.
Yeah.
It's about the source and the circumstances of its creation. You have to assess the whole picture.
Makes sense. What else affects reliability?
Documentation is huge. Rule 4. Written evidence is much, much better than oral evidence. Getting something verbally from management, even the CEO.
Needs backing up.
Absolutely. It needs corroboration. We might get management representation letters, which are written, but they are representations from management. They don't stand alone as sufficient evidence on their own for key matters. We need supporting documents, emails, contracts, something tangible. Oral evidence alone, very weak.
Not worth the paper it's written on.
Precisely. And related to written evidence, Rule 5. Original documents are better than photocopies or, digital copies.
Because they can be altered more easily.
Far too easily these days. Think about a PDX scan. It's relatively simple to edit. For really critical documents, property title deeds, major loan agreements, share certificates, the auditor will often insist on inspecting the original to confirm authenticity. #TC. The 5 procedures for obtaining evidence. The vowels, A-E-I-O-U-R.
Okay, so we know what makes evidence sufficient and appropriate, and we understand the reliability hierarchy. Now, how do we actually get this evidence? What are the tools in the toolbox?
The syllabus handily groups these into 5 main types of procedures, sometimes remembered with the mnemonic A-E-I-O-U, although sometimes R is used instead of U. Let's go with A-E-I-O-R.
Okay, A.
A is for analytical procedures. This is about evaluating financial information by studying plausible relationships. Think ratios, trends, comparisons to budgets or industry data. We'll come back to this one because it's quite important.
Got it. E.
E is for inquiry and confirmation. Inquiry is basically asking questions of management, employees, the client's lawyers. Confirmation is a specific type of inquiry where we ask an external third party to respond directly back to us, the auditor.
Like the bank confirmation or the receivables confirmations we mentioned.
Exactly. Customer confirms their balance, supplier confirms theirs, bank confirms the cash balance, and any loans.
Okay. I.
I is for inspection. This actually covers 2 things. First, inspecting records or documents, looking at invoices, contracts, board minutes. Second, inspecting tangible assets, physically looking at inventory items, machinery, buildings.
So reading paper and kicking tires, basically.
Kind of, yeah. Then O is for observation. This means watching a process or procedure being performed by others.
Like watching the client's staff carry out the inventory count, or watching how they handle incoming mail and cash receipts.
Precisely. You're observing their controls in action. But there's a catch with observation.
People behave differently when watched. The Hawthorne effect.
You got it. Staff might perform the control perfectly because you're standing there. So observation tells you the control can be done, but not necessarily that it's done consistently when you're not watching. Which is why the next one is often stronger.
R.
R is for recalculation and reperformance. Recalculation is straightforward, mathematical, checking footing columns, checking calculations like depreciation or invoice extensions. Reperformance is where the auditor independently executes procedures or controls that were originally performed by the client.
So instead of just watching them do a bank reconciliation, we actually redo it ourselves using their documents.
Exactly. Or we reperform the aging of receivables. Or reperform a control like matching delivery notes to invoices. This gives much stronger evidence than just observation because we've done it ourselves.
Okay, that distinction is important. Observation sees it happen. Reperformance proves we can make it happen the same way, verifying the process or calculation.
Yes, verifying the mechanics of it. #D, the role of analytical procedures, AP.
You said we'd come back to analytical procedures, APs. They seem a bit different from the others, less about individual transactions, more about the bigger picture.
They are. APs are defined as evaluating financial information by analyzing plausible relationships among both financial and non-financial data. It's not just calculating ratios. It's asking, does this relationship make sense?
And you mentioned they're mandatory at certain stages. That sounds like key exam knowledge.
Absolutely critical. APs are mandatory at 2 stages of the audit. First, during the planning stage. For risk assessment. To help identify areas of potential misstatement. Imagine you're looking at a retail client and you calculate their inventory turnover days. Last year was 30 days. This year it's jumped to 90 days.
Whoa, something's changed.
Right. That's a red flag. Why has it tripled? Is there obsolete stock they haven't written down? Did they buy way too much inventory? Are sales falling off a cliff? The AP doesn't give the answer, but it points you directly to where you need to focus. Your detailed testing in this case, inventory valuation and existence, and maybe sales completeness.
So it helps scope the audit and direct resources efficiently. Makes sense. What's the second mandatory stage?
At the very end of the audit, during the final review stage, before signing the audit report, the engagement partner needs to step back and look at the financial statements as a whole. Do the final numbers, after all adjustments, make sense in the context of their understanding of the business?
Like a final sanity check.
Exactly. If the company is reporting, say, record profits, but their cash flow from operations is negative and their receivables collection period has doubled, does that picture hang together? Maybe not. It prompts final questions and ensures the overall conclusion is reasonable.
Okay, mandatory at planning for risk, mandatory at final review for overall conclusion. What about in the middle, during the substantive testing phase?
Good question. During the main testing phase, APs are optional substantive procedures. They can be used to gather evidence about certain account balances or transactions, but only under specific conditions.
Such as?
The relationship needs to be plausible and predictable. For example, payroll expense should generally move in line with the number of employees. Rent expense should be predictable based on the lease agreement. If the relationship is stable and the assessed risk for that account is low, ATs might provide enough evidence on their own or reduce the need for detailed testing.
So instead of checking every single payslip, you might confirm the total payroll expense looks reasonable given the change in headcount.
Potentially, yes. But if the relationship isn't predictable, think legal fees or repairs and maintenance costs, which can fluctuate wildly, then APs are unlikely to be effective as a primary substantive test. You need to rely on inspection, recalculation, inquiry, etc.
Right. So know when they're mandatory, planning review, and understand their limitations when used optionally for substantive evidence. Got it. Okay, moving on. We've got our procedures, but we almost never apply them to everything, do we? Testing 100% of transactions in a large company would take forever and cost a fortune.
Exactly. It's just not feasible or economic. Audits operate under time and cost constraints. That's why we use audit sampling. We select and test a portion of the population, say a sample of sales invoices or inventory items, and then we project the results from that sample back to the entire population.
But isn't there a risk there? What if the sample we pick isn't typical? What if we happen to pick all the good ones and miss the errors?
That's the inherent risk. Precisely. It's called sampling risk. The risk that our sample isn't representative of the population, leading us to draw the wrong conclusion. Maybe we conclude controls are effective when they're not, or that there's no material misstatement when there actually is.
So how do we manage that risk?
The key definition of audit sampling under ISA 530 is that it must give all items in the population a chance of selection. The selection process needs to be unbiased. If we can achieve that, we can use statistical methods to measure and control the sampling risk. #B. Statistical versus non-statistical sampling.
Okay, unbiased selection. This sounds like it leads to the difference between statistical and non-statistical sampling.
It does. Statistical sampling has 2 key characteristics. First, the sample selection must be random or systematic with a random start something to remove human bias. Second, we use probability theory to evaluate the sample results and measure the sampling risk.
So you can make a statement like, based on our sample, we are 95% confident that the error in the total population doesn't exceed X dollars.
Exactly. You can quantify the level of assurance you've obtained and the remaining risk.
And non-statistical.
Non-statistical sampling is basically anything that doesn't meet both of those conditions. Maybe the selection method isn't truly random, perhaps we use haphazard selection, or maybe we don't use probability theory to evaluate the results.
So it's more judgmental.
Entirely judgmental. You rely on experience and knowledge of the client. You can still draw conclusions, but you can't mathematically state the level of confidence or measure the sampling risk precisely. It's often used, especially in smaller audits or for specific procedures, but it lacks that statistical rigor. #C, selection methods and their risks.
Okay, let's talk about the specific ways we can actually select the sample items. You mentioned random selection for statistical sampling.
Yes, random selection is theoretically the best way to ensure every item has an equal chance and remove bias. You could use random number generators or specialized audit software to pick items from a numbered population.
But does the population always have numbers, like a pile of physical invoices?
Good point. If the population isn't pre-numbered or easily numberable in a data file, pure random selection can be difficult or time-consuming to implement. That's why systematic, or interval selection, is often used as a practical alternative.
How does that work?
You calculate a sampling interval, say n, then you pick a random starting point within the first n items and then select every nth item thereafter. For example, pick a random invoice from the first 100 and then select every 100th invoice after that.
So invoice hashtag 57, then hashtag 157, hashtag 257, and so on.
Exactly. It's efficient, and as long as the population doesn't have some weird pattern that matches your interval, it usually provides a sample that's close to random. It's widely used in practice.
Okay, those sound statistically sound. What about the less rigorous methods? You mentioned haphazard selection.
Haphazard. This is where you select items without following any structured technique. You just pick items from a file or a list.
Sounds easy.
It is easy, but it's highly susceptible to unconscious auditor bias. We tend to avoid things that look messy or complicated, or maybe we pick the first few items because they're easy to reach. The resulting sample is almost certainly not representative.
So not suitable for statistical sampling.
Definitely not. It should generally be avoided if you intend to project the results to the population, as it provides very weak evidence due to the high risk of bias.
What about block selection? Selecting, say, all sales invoices from the first week of March.
Also generally inappropriate for drawing conclusion about the whole year. That block might not be typical. Perhaps controls were different then, or a specific type of transaction dominated. It rarely represents the population as a whole. You might use it to check, say, if a specific procedure was followed during that 1 week, but not much more.
Okay, so random and systematic are good for representative samples. Haphazard and block are generally weak. Are there smarter ways to select?
Yes, we often use techniques to make sampling more efficient and effective. One is stratification.
Breaking the population down.
Exactly. You divide the population into subgroups, or strata, that have similar characteristics. A common example is with receivables or payables. You might find that 80% of the total balance is made up of just 10 large customer accounts, while the remaining 20% is spread across 500 small accounts.
So instead of sampling across the whole lot,
You stratify. You test 100% of those 10 large accounts because they're individually material. Then you take a smaller sample from the stratum of 500 small accounts where the risk of a material misstatement from any single item is much lower. This focuses your effort where the risk is highest and often reduces the total sample size needed.
that makes a lot of sense. Focus the firepower.
Right. And another intelligent technique, particularly useful for testing monetary balances, is monetary unit sampling, MUS, sometimes called value-weighted selection.
How does that work? It sounds like it focuses on dollars rather than transactions.
It does. In MUS, each individual dollar, or pound or euro in the population is treated as a sampling unit. So an invoice for $10,000 has 10,000 chances of being selected, while an invoice for $100 only has 100 chances.
Ah, so the bigger the balance, the more likely it is to get picked.
Exactly. It automatically biases the selection towards the higher value items, which is very efficient because that's where the biggest potential misstatements usually lie. If you find an error in a $10,000 item selected via MUS, it likely points to a larger potential issue than an error in a $100 item.
Clever.
Okay.
Okay, so when we're planning our sample, regardless of the method, what factors determine how many items we need to select? The sample size.
Several key factors drive the sample size calculation, and you absolutely need to know these for the exam. First, the auditor's assessment of the risk of material misstatement. Higher ROM generally requires a larger sample.
Makes sense. More risk, more testing.
Second, the tolerable misstatement or tolerable deviation rate for controls. This is the maximum amount of error the auditor is willing to accept in the population and still conclude that the account is fairly stated or the control is effective.
So if I set a lower tolerable misstatement, meaning I'm less tolerant of errors,
You need a larger sample size. You need more precision. Third, the expected misstatement or expected deviation rate. If you expect to find more errors based on prior experience or your risk assessment, you need a larger sample to get a reliable estimate of the actual error rate.
okay, higher expected error, bigger sample.
And finally, the auditor's desired level of confidence, or conversely, the acceptable sampling risk. If you want higher confidence, say 95% confidence instead of 90%, you need a larger sample size to reduce the sampling risk.
Right. More certainty requires more work. So ROCM, tolerable misstatement, expected misstatement, and desired confidence level all influence the sample size. Hashtag D. Evaluating sample results.
Okay, we've planned our approach, selected our sample using an appropriate method, performed our tests using AEIOUR. Now we have the results. How do we evaluate them? Let's start with tests of controls.
For tests of controls, the outcome is usually binary. Either the control worked as intended or it didn't. That's deviation.
No.
So we calculate the sample deviation rate.
Simple percentage. Number of deviations divided by sample size. Exactly. Let's say we tested 60 purchase order approvals, and we found 3 instances where the approval was missing or done by the wrong person. Our sample deviation rate is 3 out of 60, which is 5%.
Okay, 5%. Is that good or bad?
It depends on what we decided before we started testing. We would have set a tolerable deviation rate, the maximum rate we could accept, and still conclude the control is effective enough to rely on. Let's say we set the tolerable rate at 4%.
Uh-oh. Our sample rate of 5% is higher than our tolerable rate of 4%.
Correct. In this case, the sample results do not support our initial plan to rely on that control. The control appears to be ineffective more often than we can accept.
So what's the consequence? What do we do now? This is crucial for the exam, right?
Absolutely crucial. The immediate consequence is we cannot rely on that control to reduce our substantive testing as planned. We must increase the extent of our substantive procedures for the related assertion, for example, occurrence or accuracy of purchases. We have to get our assurance directly from testing the account balances or transactions, not from relying on the failed control.
We pivot strategy. More detailed testing.
Yes. We also need to investigate why those deviations occurred. Were they one-offs, anomalous errors, or do they indicate a systematic problem with the control process? Understanding the cause helps assess the broader implications.
Okay, that's controls. What about evaluating results for tests of details, where we're looking for monetary misstatements in account balances?
Here, we're not just counting deviations, we're quantifying the monetary value of the errors found in the sample. Let's say we sampled $50,000 worth of receivables from a total population of $500,000. And in our sample, we found $1,000 of overstatement errors.
Okay, a $1,000 error in a $50,000 sample.
Now we need to project that error found in the sample onto the entire population to estimate the total likely misstatement. A common method is the ratio method.
How does that work?
You calculate the error rate in the sample, a $1,000 error, $50,000 sample value equals 2%. Then you apply that rate to the total population value. 2% of $500,000 equals $10,000.
So our best estimate of the total overstatement in receivables is $10,000.
Based on this sample, yes, that's the projected misstatement. But there's a potential complication. Anomalous errors.
Errors that are clearly just one-offs, not typical of the population.
Exactly. Let's say $800 of that $1,000 error was due to a single specific data entry mistake that we've investigated and confirmed is highly unlikely to have happened elsewhere. It's genuinely a freak event, not representative of a systemic problem.
So we wouldn't project that $800.
Correct. Anomalous errors are identified as misstatements themselves, but they're not included in the projection calculation because they don't represent the likely error in the rest of the population. So we'd only project the remaining $200 of error. $1,000 total, $800 anomalous.
Okay, so project the $200, $200,000, $500,000, $2,000 projected error, plus the $800 anomalous error itself gives a total likely misstatement of $2,800.
Precisely. You add the projected systematic error, $2,000, to the identified anomalous error, $800.
Much lower than the initial $10,000 projection. Identifying anomalies matters.
Hugely. Then, the final step is to compare this total likely misstatement, $2,800 in our revised example, to the tolerable misstatement we set for receivables during planning.
Let's say tolerable misstatement was $5,000.
Since $2,800 is less than $5,000, the sample results suggest the population is likely acceptable. We might still ask management to correct the $1,000 actual errors found, but the projected error is within tolerance.
But if the total likely misstatement exceeded the tolerable misstatement,
then we have a problem. We either need to ask management to investigate and correct the errors, potentially perform additional audit procedures to get a more precise estimate or refine our understanding, or if management refuses to adjust and the projected error remains material, we'd have to consider modifying the audit opinion.
Okay, this is all making sense. We gather sufficient appropriate evidence using various procedures, maybe involving sampling, and we evaluate the results. But you keep mentioning we need to link procedures back to assertions. What exactly are assertions in this context?
Think of assertions as The claims that management is making, implicitly or explicitly within the financial statements. Every number, every disclosure is essentially asserting something.
Like when the balance sheet shows property, plant, and equipment. $10 million it's claiming. What?
It's claiming several things. It's claiming those assets actually exist, existence assertion. It's claiming the company owns or controls them, rights and obligations. It's claiming they are valued correctly, considering depreciation and impairment, accuracy, valuation, and allocation. And it's claiming that all the relevant PPE is included. Completeness.
Wow. Okay. One number makes multiple claims.
Absolutely. And ISA 315 requires us, the auditors, to identify and assess the risk of material misstatement at the assertion level. We don't just assess risk for receivables. We assess the risk for existence of receivables, valuation of receivables, completeness of receivables, and so on.
Because the risks might be different for each assertion.
Exactly. For receivables, the biggest risk is usually existence. Are they real? And valuation. Will we collect them? Completeness, have we recorded all receivables, is usually a lower risk. But for payables, it's the opposite. Completeness, have we recorded all our debts, is the huge risk, while existence is usually less of a concern.
So the risk profile drives which assertions we focus on, which in turn dictates the specific audit procedures we need.
You've nailed it. That's the golden thread. Risk assertion procedure. The syllabus and exams focus heavily on two main categories of assertions, often remembered using the mnemonic ACCA cover. Well, sort of. Let's break them down. ####B. Assertions about classes of transactions and events. ACCA cover.
Okay, first category. Assertions about classes of transactions and events. These relate mainly to the income statement items, right? Things that happen during the period.
That's right. Transactions during the year, sales, purchases, expenses. The key assertions here are occurrence. Did the recorded transactions and events actually happen, and do they pertain to the entity? This combats the risk of fictitious sales or expenses.
Did it really occur? Okay.
Completeness. Were all transactions and events that should have been recorded actually recorded? This is a big risk for expenses and liabilities, the temptation to omit them.
Is everything included? Got it.
Accuracy. Were the amounts and other data relating to recorded transactions recorded appropriately? Correct prices, quantities, calculations, exchange rates.
Was it recorded at the right amount? Yep.
Cutoff.
Yeah.
Were transactions recorded in the correct accounting period? This is crucial around the year end. Recording next year's sales and this year's results, or pushing this year's expenses into next year.
Right, period. Okay.
And classification and presentation. Were transactions recorded in the proper accounts? And are they clearly described and disclosed in the notes? Think distinguishing between capital expenditure and repairs expense.
Right account, clear description. Occurrence, completeness, accuracy, cutoff, classification, presentation. Okay. ###. Assertions about account balances. ACCA cover. And the second category, assertions about account balances. These are about the balance sheet at the end of the period.
Exactly. Assets, liabilities, equity balances at the year-end date. The assertions are slightly different but overlap conceptually. Existence. Do the assets, liabilities, and equity interest actually exist at the period end? Are those receivables real customers? Is that inventory physically there?
Does it exist?
Rights and obligations. Does the entity hold or control the rights to the assets? And are the liabilities actually obligations of the entity? We own the building, we owe the loan.
We own into it. Right.
Completeness.
Yeah.
Are all assets, liabilities, and equity interests that should have been recorded actually included? Again, the major risk for liabilities. Have we included all loans, all accruals?
Is everything included? Similar to transactions, but for balances.
Accuracy, valuation, and allocation. AVA. Are assets, liabilities, and equity included at appropriate amounts?
Yeah.
And have any resulting valuation or allocation adjustments been appropriately recorded? This covers depreciation, impairment, allowances for doubtful debts, valuing inventory at the lower of cost, and NRV. It's a big one.
Right amount considering all adjustments.
Yeah.
AVA.
Yep. And finally, classification and presentation again. Are balances recorded in the proper accounts and clearly described and disclosed in line with the relevant accounting standards? Current versus non-current assets, liabilities, for example.
Right account, clear description. Existence, rights and obligations, completeness, AVA, classification and presentation. Got it.
So for every single audit test you design or read about in an exam question, you need to ask, which assertion is this procedure primarily designed to address? Making that link explicit is key to scoring well. #TADV. Deep dive into substantive procedures.
Right, let's put this all together now. We understand evidence, sampling, and assertions. Let's dive into the specifics for some key account balances, linking the procedures directly back to those assertions, starting with trade receivables, Chapter 17.
Okay, receivables. As we said, the primary risks are usually existence, do these customers actually owe us money? And accuracy, valuation, and allocation, AVA, are the amounts correct? And more importantly, are they collectible? Hashtag A, trade receivables, CH17.
So for existence, the classic procedure is external confirmation or circularization.
It's the cornerstone, yes. Sending letters directly to customers, asking them to confirm the balance they owe the client as at the year-end date. And crucially, the auditor must control this process.
Control meaning?
We select the customers to confirm, we prepare or check the confirmation letters, we mail them ourselves, and the responses must come directly back to us, the auditors, not to the client. This maintains independence and reliability.
Okay. And there are two types, positive and negative.
Correct. Positive confirmation asks the customer to reply whether they agree or disagree with the balance shown. You always want to reply back.
When would you use positive?
You use positive when the risk of misstatement is assessed as high, or when there are large individual balances, or if you suspect disputes or inaccuracies. It provides much stronger evidence because you expect a response. If you don't get one, you have to perform alternative procedures.
Like if a customer doesn't reply to a positive confirmation.
The best alternative procedure is usually to check after-date cash receipts. If you see the customer paid that specific balance shortly after the year-end, that's excellent evidence the debt existed and was accurate at year-end. You might also examine supporting delivery notes and sales orders for that balance.
Okay. And the other type, negative confirmation.
Negative confirmation only asks the customer to reply if they disagree with the balance. If they agree, they're asked not to respond.
That sounds less reliable. Silence doesn't necessarily mean agreement, does it? They might have just thrown it in the bin.
Exactly. It's much weaker evidence. It's only considered appropriate if all of the following conditions are met. The assessed risk of material misstatement is low. The population consists of a large number of small, similar balances. You expect a very low exception rate, and you have no reason to believe the recipients will just ignore the requests.
So quite limited circumstances for negative. Mostly we'd use positive.
Generally, yes, especially for material balances or higher risk areas. Now remember, confirmations primarily test existence and to some extent accuracy. They tell you the customer agrees they owe the money. They do not tell you if the customer is actually able to pay it.
So confirmation doesn't cover the valuation part of AVA? The collectability?
Not directly, no. For valuation, we need different procedures. The most important is reviewing the age receivables listing.
Seeing how old the debts are?
Yes. Debts that are overdue for a long time, say over 90 or 120 days, are much less likely to be collected. We need to assess the adequacy of the client's allowance for doubtful debts based on this aging profile, their collection history, and any specific information we have about customer difficulties.
And checking after-date cash receipts helps here too, right? If an old debt gets paid in January, it proves it was collectible at December 31st.
Absolutely. It's the best proof of recoverability for specific balances. We also scrutinize correspondence with customers, are the disputes mentioned, and we look closely at credit notes issued just after the year end.
Why specifically then?
It's a potential red flag for manipulation. A company might be tempted to inflate sales just before the year end by booking fictitious invoices or sending out goods the customer didn't really order.
Knowing they'll just issue a credit note in January to reverse it after the reporting date has passed.
Precisely. So we trace significant credit notes issued post-year end back to the original sale. Was it a genuine return? Or was the original sale questionable? This addresses occurrence of the original sale as well as the valuation of the related receivable at year-end.
Okay, an analytical review. Calculating receivables days.
Yes, calculating the average collection period and comparing it to the prior year and industry averages. A significant increase in collection days could signal worsening collectability and the need for a higher doubtful debt allowance. #B. Trade payables.
Okay, let's switch sides. Trade payables, Chapter 18. You said the big risk here is the opposite of receivables. It's completeness. Worried about understatement.
Exactly. Management might be tempted to delay recording invoices or omit liabilities to make the company look healthier. So our primary focus is ensuring all liabilities that should be recorded are recorded.
How do we test completeness for payables? Confirmations again.
We can use payable confirmations, sending letters to major suppliers, asking them to confirm the balance they say the client owes them. But it's often less effective than for receivables.
Why is that?
Suppliers might be less motivated to respond accurately if the balance shown is lower than what they think is owed. And crucially, sending confirmations only to suppliers already listed in the client's ledger won't help you find liabilities that have been completely omitted.
Ah, right. It won't find the missing suppliers.
Exactly. So while confirmations can be part of the mix, the more powerful procedures for completeness are different. The main one is performing or reperforming supplier statement reconciliations.
Getting the statement directly from the supplier and comparing it to the client's payable ledger balance for that supplier?
Yes. We obtain the supplier statement showing their record of the transactions and the balance they claim is outstanding. We then reconcile that to the client's records, investigating any differences. If the supplier statement shows a higher balance owed, the difference often represents unrecorded invoices or payments cleared by the supplier, but not yet by the client's bank. This is a core procedure.
Okay, that finds discrepancies for known suppliers.
Yep.
But how do we find those completely unrecorded liabilities? The missing suppliers.
That's where the search for unrecorded liabilities, SRUL, comes in. This is absolutely critical for testing completeness.
How does the search work? What are we looking for?
We primarily look at payments made after the year end. We review the cash disbursements journal or bank statements for, say, January and maybe early February. If we see payments being made to suppliers, especially significant amounts,
We trace them back.
we trace them back to the supporting documentation, the supplier invoice. We then look at the date of that invoice, and more importantly, the date the goods or services were actually received, evidenced by, say, a goods received note or GRN.
And if the goods were received before the year end?
Then that liability existed at the year end and should have been recorded or accrued, even if the invoice itself arrived later. If it wasn't recorded, we found an unrecorded liability.
So SRUL is about looking at post-year-end activity to find things that should have been in the year-end balance.
Precisely. We can also trace forward from source documents, selecting a sample of GRNs received just before year-end and tracing them forward to ensure a corresponding payable or accrual was recorded.
And analytical procedures for payables days.
Yes, calculating the average payables payment period. If it has suddenly decreased significantly compared to prior years or industry norms, it might suggest that liabilities have been deliberately omitted to make the ratio look better. It warrants investigation. #C accruals and prepayments, CH19.
What about related items like accruals and prepayments, Chapter 19? These often involve estimates and timing. Assertions like accuracy and cutoff seem key.
They are. For many accruals like rent, utilities, salaries, they are often recurring. So a key procedure is comparison with the prior year and assessing the reasonableness of any changes. We might recalculate specific accruals based on underlying agreements or known usage patterns.
Similar to the search for unrecorded liabilities, we'd also look at invoices received or paid just after year-end.
Exactly. Scrutinizing payments and invoices around the year-end helps identify expenses incurred before year-end but not yet paid, requiring an accrual, or payments made before year-end for services relating to the next period, requiring a prepayment.
And consistency is important here too, especially linking back to inventory.
Very important. If the inventory count procedures identify goods that have been received but the invoice hasn't arrived yet, the classic goods received, not invoiced or GR&I list.
Those goods are included in the inventory asset figure.
So we must ensure a corresponding liability, an accrual, is included in payables for the estimated cost of those goods. The inventory existence must match the liability completeness and accuracy. It's all about that consistent cutoff. #tag DAOA, inventory CH20.
Okay, let's tackle the big one. Inventory, Chapter 20. Lots of complexity here. Key assertions seem to be existence, valuation, part of AVA, and that critical cutoff again.
Absolutely. Inventory hits both the balance sheet and the cost of goods sold, so getting it right is vital.
Let's start with existence. How do we prove the inventory is actually there? The year-end stock count or stock take?
The physical inventory count is the primary procedure for existence, but it's crucial to remember the auditor's role. We don't conduct the count for the client. Our job is to observe and evaluate the effectiveness and reliability of management's count procedures.
So we attend the count, but as observers, what are we looking for?
We evaluate the whole process before it starts. Are the instructions clear? Are count areas properly organized and tidy? Are account teams set up, maybe pairing warehouse staff with someone independent like accounts staff? Are count sheets or tags pre-numbered and controlled to prevent loss or omission?
Okay, checking the planning and controls. What about during the count itself?
We observe the count teams in action. Are they following the instructions? Are they identifying and segregating damaged or obsolete items? Crucially, we perform test counts ourselves.
Test counts.
Yes, on a sample basis. We do it in two directions. First, we select items physically from the shelves or floor and trace them to the client's count sheets or tags. This tests the completeness of the account records, ensuring everything physically present gets recorded.
Physical to sheet. Completeness.
Okay. Then we select entries from the client's count sheets or tags and go and physically find those specific items on the shelves. This tests the existence assertion, ensuring items recorded on the sheets actually exist.
Sheet to physical existence. Got it. That dual approach covers both bases.
Exactly. We also pay close attention to the cutoff procedures during the count, ensuring that goods received during the count are segregated and treated correctly, and that no goods are dispatched. And we record the serial numbers of the last goods received notes, GRNs, and dispatch notes, DNs, used before the count started.
We'll come back to why those last numbers are so important for cutoff later. So that's existence covered by observing the count. What about valuation? Inventory needs to be at the lower of cost and net realizable value, NRV.
Correct. Testing valuation is often complex. First, cost. We need to test how the client determines the cost figure. What costing method are they using? FIFO, weighted average? Is it appropriate? We then test the application tracing costs back to purchase invoices for raw materials, checking the allocation of labor and overheads for work in progress and finished goods. This involves recalculation and inspection of costing records.
Okay, checking the C in cost or NRV. What about the NRV, net realizable value?
NRV is the estimated selling price in the ordinary course of business, less the estimated cost of completion and the estimated cost necessary to make the sale. We need to identify inventory items where NRV might be lower than cost.
How do we find those potential problem items?
We look for evidence of slow-moving, obsolete, or damaged inventory. Reviewing inventory aging reports or turnover ratios as key items sitting around for a long time are high risk. We physically look for damaged goods during the count observation. We discuss potential obsolescence issues with management.
And then how do we check the NRV estimate itself?
The best evidence is often looking at post-year-end sales invoices. If items from year-end inventory were sold in January for less than their recorded cost, that's direct evidence that NRV was lower than cost at year-end, and a write-down is needed. We also consider selling prices on current price lists and factor in selling costs.
Okay, cost-tested NRV assessed. Now, that third crucial assertion, cutoff. You mentioned recording the last GRN and DN numbers at the count.
Yes, this is absolutely vital for ensuring transactions around the year-end are recorded in the correct period, which directly impacts both the inventory valuation and the profit figure.
How does it work?
We take the number of the last GRN before year-end. We then trace items received on GRNs up to that number to ensure they are included in the physical inventory count and included in trade payables or the GRNI accrual. Goods received after that GRN number should be excluded from both.
So inventory in, liability in, consistency.
Precisely. And we do the reverse for sales. We take the number of the last dispatch note, DN, or delivery note before year-end. We trace sales recorded up to that DN number to ensure the goods were physically dispatched and are therefore excluded from the closing inventory count, and that the sale and corresponding receivable are recorded in the current period. Goods dispatched after that DN should remain in inventory, and the sale recorded next year.
Goods out, inventory out, sale in. Consistency again, get the cutoff wrong, and inventory and profit are misstated.
Exactly. It's a common exam area because it links the balance sheet, inventory, payables, receivables, and the income statement, cost of sales revenue, directly. #, E, bank and cash, CH21.
Okay, let's move to something perhaps a bit more straightforward but still critical. Bank and cash, Chapter 21. Assertions here presumably existence and accuracy.
Primarily, yes. Is the cash actually there, and is the balance correct? While often lower risk in terms of complexity, bank and cash has a high inherent risk due to its liquid nature and susceptibility to theft or fraud.
So how do we verify the bank balance?
The main piece of evidence is the bank confirmation letter, also known as the bank report for audit purposes or bank certificate. We send a standard request, authorized by the client, directly to all the client's banks.
And the bank applies directly back to us, the auditor.
Yes, critically important. The bank confirms the year-end balances on all accounts, current, deposit, loan, details of interest rates, any securities pledged, or guarantees given. This provides strong, independent evidence for existence, accuracy, rights, and obligations for loan security, and even completeness if they list accounts the client hadn't told us about.
What about the bank reconciliation? The client prepares one reconciling the bank statement balance to their own cash book balance. What do we do with that?
We need to test it thoroughly. We reperform the reconciliation. We agree the balance per the bank statement line item on the reconciliation directly to the independent bank confirmation letter we received. We agree the balance per the cash book on the reconciliation to the client's general ledger.
And the reconciling items, deposits not yet credited, checks not yet presented.
We trace them to the post-year-end bank statement. We need to verify that those outstanding deposits actually cleared into the bank shortly after year-end, and that those unpresented checks were actually paid by the bank shortly after year-end. If they don't clear reasonably quickly, it could indicate issues like window dressing or errors. This tests the accuracy and existence of those reconciling items.
Makes sense. What about physical cash held on site? Petty cash.
Even if the amount is immaterial to the financial statements overall, we usually perform a physical cash count close to the year-end.
Why, if it's immaterial?
Because of the high inherent risk of misappropriation. A surprise cash count can be a deterrent and helps verify controls over cash handling. We count the cash and agree it back to the petty cash records. Hashtag F. Non-current assets, CH22.
All right, let's look at non-current assets, NCAs, or fixed assets, Chapter 22. Things like land, buildings, machinery. These are often high value, but maybe lower volume of transactions than inventory or receivables. What are the key assertions?
For NCAs, the big ones are usually existence. Do they physically have the asset? Rights and obligations, do they actually own it? And valuation, is it recorded at the correct amount, considering depreciation and impairment? Completeness can also be a risk, especially ensuring additions are capitalized correctly.
Okay, how do we test existence?
The most direct way is physical inspection. We select a sample of assets from the client's fixed asset register and physically go and verify that they exist, noting their condition and whether they appear to be in use.
Does that physical inspection also help with valuation? Seeing the condition?
It certainly can. If we see assets that are clearly damaged, idle, or technologically obsolete during our inspection, that's strong evidence indicating a potential impairment issue. It prompts us to investigate whether management has performed an impairment review and if any write-down is necessary, part of the AVA assertion.
How about rights and obligations? Just seeing a machine doesn't mean the client owns it, right? It could be leased.
Absolutely critical point. For ownership, we need to inspect documents of title. For property, that means looking at title deeds or land registry documents. For vehicles, registration documents. For significant additions, we examine purchase invoices and contracts to confirm the asset was purchased by and belongs to the entity.
Okay, title docs for rights and obligations. What about testing additions and disposals during the year, accuracy and completeness?
For additions, we vouch a sample from the asset register back to purchase invoices, delivery notes, and potentially board minutes authorizing the capital expenditure. This confirms existence, rights, and accuracy, cost. For disposals, we trace them from the asset register to supporting documentation like sales invoices or disposal authorizations, and we recalculate the profit or loss on disposal, checking the removal of cost and accumulated depreciation was correct.
You mentioned completeness risk for additions. How do we check they haven't mistakenly treated capital expenditure as just a repair expense?
That's a key test. We need to scrutinize the repairs and maintenance R&M expense account. We select a sample of significant debits from the R&M account and examine the supporting invoices and descriptions. We're looking for items that should actually have been capitalized because they improved the asset or extended its useful life rather than just maintaining it.
So if they expensed, say, a major engine overhaul for a machine instead of capitalizing it.
Then assets are understated, completeness classification violation, and profit for the year is also understated or potentially smoothed. We need to ensure the capitalization criteria are applied correctly.
And finally, valuation beyond impairment depreciation.
Yes, we need to test the depreciation charge. We check the reasonableness of the accounting policies, use the useful economic lives, the residual values, the depreciation method, straight line, reducing balance. Are they appropriate for the types of assets and consistent with prior years? Then, we reperform the depreciation calculation for a sample of assets or on an overall basis to ensure it's mathematically accurate. Tag 6. Evidence from others, Chapter 23.
Okay, we've covered a lot of ground on procedures we perform. But audits, especially larger ones, often involve relying on the work done by others. Chapter 23 deals with this, specifically using the work of internal audit and experts. This reliance isn't automatic, though, is it?
Not at all. There are strict standards governing when and how we can rely on others because ultimately, the external auditor remains solely responsible for the audit opinion. We can't just delegate that responsibility. Tag A. Using the work of internal audit. IA.
Let's start with internal audit, IA. Many larger companies have an internal audit function. Can we, as external auditors, use their work to reduce our own testing?
We may be able to, according to ISA 610, but only if the internal audit function meets three crucial criteria. We have to evaluate them against these criteria before deciding to rely on their work.
What are the three criteria?
First, objectivity. Does the IA function have sufficient organizational status to perform its duties without bias or undue influence? Critically, who do they report to? Reporting functionally to the audit committee or those charged with governance, TCWG, enhances objectivity, whereas reporting only to management might compromise it.
Okay, so independence within the organization matters.
Second, competence. Does the IA function possess the necessary knowledge, skills, and resources? Are the internal auditors qualified? Also hold relevant professional qualifications? Do they have sufficient experience in the industry and in auditing? Do they receive adequate training?
Competence of the team. Got it.
And third, do they apply a systematic and disciplined approach? This includes aspects like proper planning, documentation of their work, supervision and review processes, and quality control procedures over their engagements. Is their work performed to a professional standard?
Objectivity, competence, systematic approach. Do all three have to be met? What if they're super competent and systematic, but they report only to the CFO, potentially compromising objectivity? Can we still use their work?
That's the key practical challenge. ISA 610 is clear. The significance of the threats to objectivity and the level of competence and application of a systematic approach are all considered. If objectivity is significantly compromised, especially in areas involving high judgment or high risk of misstatement, the external auditor likely cannot rely on IA's work to reduce the extent of their own direct audit procedures in those areas.
So, a failure on objectivity might severely limit or even prevent reliance, even if they're technically good.
Yes, we might still be able to use their work in less risky areas, or perhaps use them to provide direct assistance under our supervision for some tasks, but we couldn't rely on the conclusions from their independent testing in high-risk areas if objectivity is flawed. We must always perform sufficient work ourselves on significant matters, #tag B, using the work of experts.
Okay, that's internal audit. What about using the work of experts? This seems common in areas like valuing complex financial instruments, pensions, or maybe mineral reserves.
It is. And the standards, ISA 620, make an important distinction here. We need to differentiate between a management's expert and an auditor's expert.
What's the difference?
A management's expert is an individual or organization with expertise in a field other than accounting or auditing, whose work is used by management to help prepare the financial statements. Think of an actuary calculating the pension liability, or a surveyor valuing investment properties for the accounts.
Okay, they help the company get the numbers right.
Whereas an auditor's expert is engaged by us, the auditors, to help us obtain sufficient appropriate audit evidence. Maybe we engage our own valuer to assess the reasonableness of management's property valuation, or an IT expert to help us test complex system controls.
So one works for the client, one works for us. Do we need to evaluate them both?
Yes, absolutely. Whether it's management's expert or our own, we must evaluate the expert's competence. Are they qualified, experienced, capability? Do they have the time and resources? And objectivity. Are they independent, free from bias?
How do we assess objectivity if it's management's expert? They're paid by the client.
It's harder, but we look for potential conflicts of interest. Are they related to the client? Do they have a financial interest? We assess the reasonableness of their assumptions and methods, comparing them to industry norms or other available data. We need to understand their work and ensure it seems reasonable.
And if we engage our own expert, an auditor's expert,
The requirements are more formal. We must agree with our expert in writing on key matters before they start. This includes the nature, scope, and objectives of their work, their respective responsibilities, the form of their report back to us, and confidentiality requirements. This ensures they understand exactly what audit evidence we need from them.
makes sense. A clear engagement letter.
And critically, whether it's management's expert or our own, we can't just blindly accept their conclusions. We need to evaluate the adequacy of their work for our audit purposes. Does it seem reasonable? Is it consistent with other audit evidence we've gathered? Did they use appropriate source data? And was that data relevant and reliable?
So we rely on their expertise in their field, but we retain responsibility for the audit conclusion based on all the evidence, including our evaluation of their work.
Precisely. The expert informs our judgment, but they don't make it for us. #tag A7. Outro and final thought.
Wow, we have really drilled down into the heart of the AA syllabus today: audit evidence, sampling, assertions, and the detailed procedures. It feels like the absolute engine room of the entire audit process.
It really is. Everything hinges on getting this right. If we were to summarize the absolute must-know takeaways for anyone facing the AA exam from today's deep dive, what would they be?
Okay, well, first, that hierarchy of evidence reliability. Understanding why external, direct, written, original evidence is generally stronger, but also knowing that internal evidence can be reliable if controls are good. That nuance is key.
Agreed. Second, for sampling, the absolute necessity of minimizing bias in selection. Random or systematic methods are needed if you want to statistically project results. Haphazard is generally weak, and knowing those factors affecting sample size risk, tolerable error, expected error, confidence.
And third, and maybe most importantly for applying knowledge in the exam, that relentless focus on linking every procedure back to a specific assertion, ACCA cover, and the underlying risk. Why this test? To address existence risk. Why that test? To address completeness risk.
That synthesis, identifying the risk, pinpointing the assertion, and then selecting the appropriate detailed procedure that is the core capability the audit and assurance exam is testing time and time again. Can you apply the theory practically?
Absolutely. But all of this discussion, all these procedures and techniques, they all assume one fundamental thing.
That we can actually get the evidence we need.
Exactly. We assume we have access. Which leads to a final, maybe provocative thought for you, our listeners, to ponder.
If the entire point of the audit is to gather sufficient appropriate evidence to form an opinion, what happens if we simply cannot get that evidence? Not because it's weak, but because it's just unavailable.
Imagine a situation, maybe management physically prevents you from attending the inventory count for a material balance, or a major overseas subsidiary's records are destroyed and you can't verify its existence or results, or the bank refuses to provide a confirmation for a significant loan.
And these aren't just isolated issues. Imagine the lack of evidence is material and pervasive, affecting numerous parts of the financial statements. If you can't get the proof, you can't form an opinion on whether the financials are true and fair.
So how does that profound lack of sufficient appropriate evidence, perhaps due to a management-imposed scope limitation, force the auditor into the most extreme reporting outcome, issuing a disclaimer of opinion, where you essentially state, we couldn't get the evidence, so we cannot even give an opinion?
It's the ultimate consequence of failing to satisfy ISA 500. The inability to gather the necessary evidence fundamentally undermines the entire purpose of the audit itself. Something to think about the limits imposed when the evidence just isn't there.
A crucial point indeed. On that note, thank you for joining us for this deep dive into audit evidence and sampling. We hope it helps solidify these core concepts for your ACCA AA exam preparation. Good luck.